Greetings from our team at Robert & Jones Wealth Management. This is Jack Jones, the managing partner, with our February monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The best part of our day is time spent directly serving you. I'm going to start with a recap of our forum that we had this past Wednesday at Perry's. It was so great seeing almost 100 clients there. We talked about the markets. I enjoyed great food and fellowship. It was great to see you there. We do plan to pick up these throughout the course of the year, so look for information about the next one of these that will be late April. So a lot of headlines involved in a volatile market so far in January. This is the end of January. Talked about the NASDAQ. Finished with a rally of 3%, but still both NASDAQ and S&P had their worst monthly performance since 2020. We've shared this before. The NASDAQ had its 66th correction since 1971. And you also see, we've shared this before about a lot of the names, predominantly tech, that were very popular during the pandemic have had a significant decline. One example is Peloton, down 23% for the year, down roughly 80% over the last 12 months. So what does January portend for the rest of the year? So going back to 1926, if you have a positive January, the average return over the 58 years that were positive was 12.5. And of the 37 years that were negative, the average was up 8.2. So again, it does mean that a good January is better for the rest of the year, but it doesn't necessarily mean a negative year. So this just speaks to kind of volatility, both in days, worst days since 1950, and the return 1 year later, which averages 31%, or the periods of time. So Black Monday, as an example, over 3+ months in 1987, went down 33.5%, but was up 21.4. Most recently, the period return from February 20 to March 23 of 20 was down 33.8%. The next 12 months up 78. So volatility is kind of back this year. But volatility is to be expected. This is a look, I know it's a busy slide, but over the last 42 years, on average, you get a 14% decline within the year, and yet 32 of these 42 years were positive. So everybody's watching bull and bear what the Fed is saying. Some of these comments aren't that clarifying. This is some recent press conferences where the Fed said it's impossible to say exactly how this is going to go, that we're going to need to be nimble. The economy is quite different this time, and that the Fed put is dead or maybe not. So people are carefully watching what is likely to be a rising rate cycle beginning next month. Some of that's going to be dependent on inflation, which we'll talk about in a second. The next read on that is this coming Thursday. So what do returns look like after the first rate hike? Again, this goes back to 94. Over the next 12 months after the first rate hike, stocks up 7.3 and bonds up 3.2, going back roughly 30 years to 1994. So where is CPI? This is the headline number, which again is a 40-year high, running at about 7. We're going to get, again, a report this coming Thursday that will probably indicate what the Fed is likely to do starting March as it relates to rates going up. We had a fantastic jobs number this past Friday, almost 500,000 jobs created. Unemployment rate did tick up, but that was due to participation rate. And more importantly, revisions over the prior months that exceeded 700,000 more jobs. So really an overall really good jobs number. There does still remain an imbalance of roughly 10 million job openings. So the employment picture is still not fully clear, but again, a very good jobs number this past Friday. So kind of what are we doing? What's our game plan? We're attempting to keep you informed through regular communication. That's one-on-one meetings, videos like this, quarterly investment forums. Manage your investments according to your strategy, your preference, your profile, and then stay on top of changes in the market environment. And that's happening quickly this year. So one of the things you'll see in the not too distant future is notes in an upcoming rebalance of advisory accounts. Again, we do that at least quarterly to bring accounts back into target and to invest in opportunistic themes. Again, you'll get a detailed note about that in the coming days. So with that, we'll close. We try to keep these brief so that you keep informed of the things that are impacting markets. We encourage you to reach out to us if you have any questions at all in any way that we can help, or have, again, any questions about what we discussed at the forum or on this video, or any way that we can serve you. Until we see you again, we hope that you stay well and take care. Bye-bye.